Welcome back to our channel. Today, we're diving into the world of gold investments, a timeless and valuable asset that has stood the test of time. Whether you're an experienced investor or just starting, this video will provide you with all the information you need to make informed decisions when it comes to investing in gold. Why invest in gold? Investing in gold can be appealing for several reasons. Hedge against inflation. Gold has historically been considered a hedge against inflation. When inflation rises, the purchasing power decreases, but gold typically holds its value better over time. Safe asset. During uncertain economic times or instability in the market, investors often flock to gold as a safe asset. Gold is seen as a store of value that can provide stability in turbulent markets. Diversification. Including gold in an investment portfolio can help diversify risk. Gold often has a low correlation with other asset classes like stocks and bonds, meaning its price movements may not necessarily align with those of other investments. This can help reduce overall portfolio volatility. Preservation of wealth. Gold has a long history of preserving wealth over the long term. Unlike fiat currencies, which can be subject to devaluation due to factors like government policies or central bank actions, gold maintains its intrinsic value over time. Liquidity. Gold is a highly liquid asset, meaning buying or selling gold can easily be similar to various forms such as coins, bars, or exchange-traded funds, ETFs. This liquidity ensures that investors can quickly convert their gold holdings into cash if needed. Long-term growth potential. While gold prices can be volatile in the short term, over the long term, gold has generally shown appreciation in value. This long-term growth potential can make gold an attractive investment for investors with a horizon. It's important to note that like any investment, gold carries its risks and may not always perform as expected. Additionally, the price of gold can be driven by various factors including supply and demand dynamics, interest rates, currency movements, and investor sentiment. Therefore, individuals considering investing in gold should conduct thorough research and consider their investment aims, risk tolerance, and time horizon before making any decisions. Factors to consider when investing in gold. Investment goals. Define your investment objectives. Whether they involve wealth preservation, portfolio diversification, hedging against inflation, or speculative trading, understanding your goals will help determine the most suitable gold investment vehicles and strategies for your needs. Risk tolerance. Assess your risk tolerance, as gold investments can be subject to price volatility and market fluctuations. Consider how much volatility you can tolerate in your investment portfolio and adjust your allocation to gold accordingly. Market conditions. Stay informed about macroeconomic factors, geopolitical events, and monetary policies that can influence gold prices. Factors such as interest rates, inflation expectations, currency movements, and global economic conditions can impact the demand for gold and its price dynamics. Costs and fees. Consider the costs associated with different gold investment options, including transaction fees, storage costs, management fees, and bid-ask spreads. Evaluate these costs relative to potential returns to ensure they do not erode your investment performance over time. Liquidity. Assess the liquidity of the gold investment vehicle you choose. Ensure that you can easily buy or sell your gold holdings without significant transaction costs or delays, especially during times of market stress or emergencies. Storage and security. Determine how you will store your physical gold if you opt for bullion or coins. Consider the costs and security implications of storing gold at home, in a bank-safe deposit box, or through third-party storage services. Tax implications. Understand the tax treatment of gold investments in your jurisdiction. Tax considerations may vary depending on the type of gold investment, holding period, and capital gains tax rates. Consult with a tax advisor to optimize your tax strategy and minimize tax liabilities associated with your gold investments. By carefully considering these factors, you can make informed decisions and effectively incorporate gold into your investment portfolio to achieve your financial goals. Risks and challenges of gold investments. Address common risks associated with gold investments, such as price volatility, liquidity issues, and storage costs. Offer strategies to mitigate risks and maximize returns when investing in gold. Price volatility. Gold prices can be highly volatile, subject to fluctuations driven by factors such as economic data releases, geopolitical events, central bank policies, and currency movements. This volatility can lead to rapid price swings, impacting the value of gold investments. Market timing. Timing the market correctly can be challenging, as gold prices can be influenced by numerous unpredictable factors. Attempting to buy or sell gold at the optimal time requires a thorough understanding of market dynamics and a willingness to accept the inherent uncertainty. Storage and security risks. Physical gold investments, such as bullion or coins, require proper storage and security measures to protect against theft, damage, or loss. Storing large quantities of gold at home can pose security risks, while using third-party storage services may involve additional costs and counterparty risks. Liquidity constraints. While gold is generally considered a liquid asset, certain forms of gold investments may have liquidity constraints, particularly during times of market stress or disruption. Selling physical gold holdings or illiquid gold assets may take time and could incur additional transaction costs. Regulatory risks. Gold investments may be subject to regulatory risks, including changes in tax laws, import-export restrictions, or government interventions in the gold market. Regulatory changes can affect the attractiveness and profitability of gold investments, impacting investor returns. Opportunity cost. Investing in gold involves opportunity cost, as capital allocated to gold may not generate income or capital appreciation in the same way as other investments, such as stocks or bonds. Depending on market conditions, holding gold may result in foregone opportunities for higher returns elsewhere. Inflation and interest rate risks. While gold is often viewed as a hedge against inflation, its performance may be influenced by changes in inflation expectations and interest rates. Unexpected shifts in inflation or interest rate policies could impact gold prices and investor sentiment. Understanding these risks and challenges is essential for investors considering gold investments, enabling them to make informed decisions, manage risk effectively, and align their investment strategy with their financial goals and risk tolerance. Long-term outlook for gold investments. Global uncertainty. Geopolitical tensions, trade disputes, and geopolitical uncertainty can contribute to market volatility and drive investors towards safe haven assets like gold. As long as geopolitical instability persists, gold is likely to remain attractive as a store of value and hedge against uncertainty. Inflation hedge. Gold has always hedged against inflation, preserving purchasing power over time. With central banks around the world engaging in expansionary monetary policies and unprecedented stimulus measures, concerns about inflation could increase demand for gold as an inflation hedge in the long run. Low interest rates. Persistently low interest rates and accommodative monetary policies can reduce the opportunity cost of holding gold, as the opportunity cost of holding non-interest-bearing assets decreases. With central banks maintaining low interest rates to support economic recovery, gold may continue to benefit from the low-yield environment. Currency devaluation. Concerns about currency devaluation or debasement can drive investors towards alternative stores of value like gold. As central banks expand their balance sheets and engage in quantitative easing programs, there may be increased demand for gold as a form of protection against currency depreciation. Portfolio diversification. Gold's low correlation with other asset classes like stocks and bonds makes it an effective diversification tool for investment portfolios. Supply constraints. The supply of gold is limited, and discoveries of large gold deposits are becoming increasingly rare. While technological advancements may improve mining efficiency, supply growth is unlikely to keep pace with rising demand, potentially supporting gold prices over the long term. Emerging market demand. Rising wealth levels in emerging markets, particularly in countries like China and India, are driving demand for gold jewelry, investment products, and central bank reserves. As we wrap up this video, remember that gold investments can be a valuable addition to your investment portfolio when done strategically and with careful consideration. Whether you're looking to protect your wealth or capitalize on market opportunities, gold offers a timeless and reliable investment option. Thank you for watching, and we'll see you in the next video. Don't forget to like, share, and subscribe for more valuable insights on investment strategies and financial literacy. Stay tuned for our next video, where we'll explore another exciting topic in the world of finance. Until next time, happy investing!